Sarah Hewin, senior economist at Standard Chartered Bank. Welcome to First Look. And I wanted to get your take on, we're seeing some starts of signs of recovery in March, in particular for the UK. Manufacturing, services, construction, they all actually unexpectedly rose. Why do we need an extra stimulus? Is it still necessary?
Well, it's true that the manufacturing and services activity turned around in March. I think that the UK economy still faces some significant headwinds. Credit remains tight. We're seeing money supply continuing to fall. The fiscal squeeze is ongoing, and in fact, we've only really seen about 20% of the cuts in expenditure that are due to come through. So we think that that's going to continue to make it very difficult for the economy to grow. In addition, of course, we've seen a rise in oil prices, and that's another factor which is likely to squeeze real incomes.
But we've got, of course, the ongoing concern about inflation. It remains well above the 2% target of the Bank of England. How, therefore, can we marry this extra stimulus with concerns about inflation? Will inflation drop below the 2%, as Mervyn King has been suggesting?
We think it will. We're already seeing quite a sharp decline in inflation as the impact of last year's VAT rise drops out. There was, of course, a very steep increase in food and commodity prices in the first half of last year. And although we've seen a rise in energy so far this year, it's been nowhere near as large as in 2011. So it's likely that headline inflation is on a sustained downtrend. And we'll think that we'll see inflation down below the 2% target by the turn of this year. Now, the problem is, of course, what happens after that. Our inflation forecasts for next year and the year after are substantially below 2%. And, of course, if this happens, then the Bank of England has missed its targets on the underside.
So potentially some room to manoeuvre, therefore, for stimulus. But you prefer more bond purchases rather than cutting the interest rate. How much do you want to see the expansion in bond purchases?
Well, I think that the Monetary Policy Committee has shown itself to be very pragmatic. They will respond to the data as they see fit. But in our view, there's certainly room for at least another £25 billion of stimulus. And thereafter, it's very much dependent upon what happens in the UK economy. And, of course, what happens in our major market in the euro area. We see the euro area in recession, and that's going to be damaging for UK exports.
And actually, therefore, do you see the pound outperforming the euro at the moment? Is Mervyn King actually in a slightly better position than Mario Draghi, his counterpart?
Yes, I mean, we think that the pound will outperform the euro. The European economy, the euro area economy, is in recession. We think that we'll see perhaps another quarter of negative growth for the first quarter. Similar headwinds to the UK, but in addition, of course, there's the issue about confidence. The debt crisis hasn't gone away, and that's likely to come back and damage business and consumer sentiment.
As we've clearly been seeing with Spanish borrowing costs on the rise for the past few days. As we saw, ADP beating analyst estimates yesterday. We've got a lot coming up, initial jobless claims and, of course, non-farm payrolls on Friday. Do you think we'll be able to meet economic forecasts on those sorts of numbers so they can continue to improve?
I mean, the non-farm payrolls are always a bit of a wild card, but our own view is that we'll see payrolls rise by 205,000. I think consensus is round about 210,000, so slightly lower than last month. But it's a move in the right direction. You have to remember, of course, that the unemployment rate at 8.3% is probably not reflecting the true level of unemployment once you take into account the very high number of discouraged workers. So in our view, it's going to take a long time before you really get back to a more normal level of unemployment.
And how can the US spur this reduction in unemployment? Are they taking the right tactic? Because we are seeing very different views going and tactics in the US and Europe, because Europe is very focused on austerity, but in the US it seems to be more focused on growth.
Yes, I mean, in the US and in Europe, and of course here in the UK, central banks are running very easy monetary policy. The difference between Europe and the US is that in Europe we're seeing a big fiscal squeeze, austerity measures taken by governments across the board. In the US, that's not happening, and we're seeing the impact of that really in a slightly firmer base. Certainly no concerns on our part about negative quarters, although we are still quite hesitant about the pace of the recovery, certainly for the first quarter of this year.
How about Europe, therefore? What do you want to see coming out of the ECB? Does the ECB need to be supporting the European economy even further Can it inject any more money into the system, another LTRO, those 3-year loans to the banks? Or really has the ECB done all it can and we've now just got to wait for the austerity measures to bite and then growth start to improve?
Well, the 3-year LTROs did a very good job in terms of supporting bank funding, and of course there's been a big move in confidence as well. It's helped peripheral bond markets. But that was a particular solution to a particular problem. So we don't see another 3-year LTRO on the horizon unless bank funding becomes a real problem again. We think that there is still a chance that we could see a rate cut, though, by the end of the second quarter. The economy is performing worse than the ECB is expecting. We think that we'll see a contraction of 0.5% this year, and that's really below even the bottom end of the European Central Bank's range.
Some more concerns to come potentially for Europe. Sarah, thank you very much. Sarah Hewin, senior economist at Standard Chartered Bank. Very good to have you for us today discussing Europe, UK and indeed the US.